Hi, we are back, and today we will be talking about cryptocurrency. Is cryptocurrency a good investment? It's possible to get filthy rich by investing in cryptocurrency, but you could also lose all your money. How can both of those things be true? Well, like most investments, crypto assets come with a host of risks but also vast potential rewards. Cryptocurrency is a good investment if you want to gain direct exposure to the demand for digital currency and the projects or business they facilitate. Several publicly traded companies can provide limited exposure to the cryptocurrency market, such as Square, PayPal, MicroStrategy, or CME Group. But those investments won't come with the same focus on a cryptocurrency or blockchain projects as investing directly in crypto asset. A cryptocurrency, broadly defined, is currency that takes the form of tokens or coins and exists on a distributed and decentralized ledger. Beyond that, the field of cryptocurrencies has expanded dramatically since Bitcoin was launched over a decade ago, and next great digital token may be released tomorrow. Bitcoin continues to lead the pack of cryptocurrencies in terms of market capitalization, user base, and popularity. Other virtual currencies such as Ethereum are being used to create decentralized financial systems for those without access to traditional financial products. Some altcoins are being endorsed as they have newer features than Bitcoin, such as the ability to handle more transactions per second or use different consensus algorithms like. Is cryptocurrency safe? There are certain risks present in the crypto market that are not as prevalent in traditional financial markets, such as those for stocks and bonds. Cryptocurrency exchanges have been prone to hacks and other criminal activity. These security breaches have led to sizable losses for investors who have had their digital currency stolen, never to be seen again. Frauds and scams are also rampant in the crypto industry. Hipsters who promise investors dazzling returns are typically unable to fulfill their lofty promises, since they far too often peddle fool's gold rather than legitimate blockchain projects. Investors who buy in the hype can suffer brutal losses when these projects eventually fail. Moreover, it's not as easy to store cryptocurrencies as it is to store stocks or bonds. While exchanges such as Coinbase make it fairly easy to buy and sell crypto assets such as Bitcoin and Ethereum, many people don't like to keep their digital assets on exchange due to the aforementioned risks or cyber attacks and theft. Instead, some prefer offline cold storage options such as hardware or paper wallets. But cold storage comes with its own set of challenges, namely the risk of losing your private keys, which would make it impossible to access your cryptocurrency. There is also the risk that the crypto project you invest in will not succeed. There are thousands of blockchain projects, and competition is fierce. Regulators could also crack down on the entire crypto industry if more governments begin to view cryptocurrencies as a threat rather than just an innovative technology. Lastly, it's important to understand that cryptocurrencies and blockchain in general are cutting-edge technologies. While that makes them exciting, it also increases the risk for investors, since much of this tech is still being developed and is not yet proven in real-world scenarios. Buying cryptocurrency is very much early-stage investing, and investors should expect venture capital-like outcomes in which the vast majority of crypto projects fail and become worthless. Only a small number of projects will ultimately succeed, and it's unclear if these big wins will be enough to offset the main losses. That said, the blockchain industry is growing stronger every day. Much needed financial infrastructure is being built, such as institutional-grade custody services and future markets. Is crypto a good long-term investment? Whether crypto assets pay off for investors will ultimately be determined by whether they achieve wide-scale adoption. Bitcoin, for example, is seen by many as an investment akin to gold. Unlike fiat currencies such as the US dollar and Japanese yen, which can seemingly be printed at the will of politicians, Bitcoin has a maximum supply of just under 21 million coins. Many investors thus view Bitcoin as a scarce asset that could increase in value as fiat currencies depreciate. Others believe Bitcoin could eventually gain extensive use as a digital form of cash, with some going so far as to say it has the potential to become the first truly global currency. Ethereum, meanwhile, wants to serve as a global computing platform. It serves as a launchpad for decentralized applications or dApps, which are open source and not controlled by a single organization. Ethereum allows the use of smart contracts, which have their terms written directly into the code and can be executed automatically. These technologies could disrupt massive industries such as real estate and banking and potentially create entirely new market. If Bitcoin and Ethereum can achieve these aims, then investors who buy their tokens today will likely be richly rewarded in the years ahead. But there are many other projects competing with these cryptocurrency leaders, and their success is not assured by any means. Are there better investments than cryptocurrency? There are other ways to potentially profit from blockchain technology besides investing directly in cryptocurrencies. One solid option is to buy the stocks of companies that are rapidly adopting this game-changing tech. As we have mentioned, Square and PayPal are offering cryptocurrency services to their users, and both of these digital payment leaders are well positioned to benefit from the rising usage of Bitcoin and other digital assets. Investing in CME Group, which operates one of the largest Bitcoin futures exchanges, is another great way to profit. Ethereum. The first Bitcoin alternative on our list is Ethereum. It is a decentralized software platform that enables smart contracts and decentralized applications, dApps, to be built and run without any downtime, fraud, control, or interference from a third party. The goal behind Ethereum is to create a decentralized suite of financial products that anyone in the world can have free access to. The applications on Ethereum are run on its platform-specific cryptographic token Ether. Ether is like a vehicle for moving around on the Ethereum platform and is sought by mostly developers looking to develop and run applications inside Ethereum, or now by investors looking to make purchases of their digital currencies. What about Litecoin? Litecoin, launched in 2011, was among the first cryptocurrencies to follow in the footsteps of Bitcoin and has often been referred to as silver to Bitcoin's gold. It was created by Charlie Lee, an MIT graduate and former Google engineer. Litecoin is based on an open-source global payment network that is not controlled by any central authority and uses script as a proof of work, which can be decoded with the help of CPUs of consumer grade. There are other coins that have a huge demand, and the next one is Cardano. It is an Ouroboros proof-of-stake cryptocurrency that was created with a research-based approach by engineers, mathematicians, and cryptography experts. The project was co-founded by Charles Hoskinson, one of the 5 initial founding members of Ethereum. After having some disagreements with the direction Ethereum was taken, he left and later helped to create Cardano. The team behind Cardano created its blockchain through extensive experimentation and peer-reviewed research. Due to the rigorous process, Cardano seems to stand out among its proof-of-stake peers as well as other large cryptocurrencies. Cardano has also been dubbed the Ethereum killer, as its blockchain is said to be capable of more. That said, Cardano is still in its early stages. While it has beaten Ethereum to the proof-of-stake consensus model, it still has a long way to go in terms of decentralized financial applications. Next one is Polkadot, also known as DOT. Polkadot is a unique proof-of-stake cryptocurrency that is aimed at delivering interoperability between other blockchains. Its protocol is designed to connect permissioned and permissionless blockchains, as well as oracles, to allow systems to work together under one roof. Polkadot's core component is its relay chain that allows the interoperability of varying networks. It also allows parachains, or parallel blockchains, with their own native tokens for specific use cases. Where the system differs from Ethereum is that rather than creating just a centralized application on Polkadot, developers can create their own blockchain while also using the security that Polkadot's chain already has. With Ethereum, developers can create new blockchains, but they need to create their own security measures, which can leave new and smaller projects open to attack. As the larger a blockchain, the more security it has. The concept in Polkadot is known as shared security. What about Bitcoin Cash? Bitcoin Cash holds an important place in the history of altcoins because it is one of the earliest and most successful of the original Bitcoin. In the cryptocurrency world, the fork takes place as the result of debates and arguments between developers and miners. Due to the decentralized nature of digital currencies, wholesale changes to the code underlying the token or coin at hand must be made due to general consensus. When different factions can't come to an agreement, sometimes the digital currency is split, with the original chain remaining true to its original code and the new chain beginning life as the new version of the prior coin complete the changes to its code. Bitcoin Cash began its life in August 2017 as a result of one of these splits. The debate that led to the creation of BCH had to do with the issue of scalability. The Bitcoin network has a limit on the size of blocks, 1 megabyte. Also, Bitcoin Cash increases the block size from 1 megabyte to 8 megabytes, with the idea being that larger blockchain can hold more transactions within them. And our last currency is Stellar. Stellar is an open blockchain network designed to provide enterprise solutions by connecting financial institutions for the purpose of large transactions. Huge transactions between banks and investment firms that typically would take several days, a number of intermediaries, and cost a good deal of money can now be done nearly instantly with no intermediaries and cost little to nothing. Stellar was founded by Jed McCaleb, a founding member of Ripple Labs and developer of the Ripple protocol. He eventually left his role with Ripple and went on to co-found the Stellar Development Foundation. Stellar Lumens have a market capitalization of $6.1 billion and are valued at $0.27 as of January 2021. Thanks for watching and listening. Please subscribe to our channel for the content like this.